Alright, y'all, look, we're gonna start a new series called Trading from Scratch. And right here, I got my dog Josh with me, one of my best friends. He just did 5 years in prison and he's fresh out. So I'm gonna be teaching him about trading and the stock market, telling him everything from ground up here. So he has no knowledge about nothing, and I'm pretty much gonna help him become a profitable trader within 6 months and help him avoid a lot of mistakes beginner traders make. So I'm gonna pass it off to my dog, introduce himself, and then we're gonna get straight into it.
All right, man. What's up? Yeah, man. My name Josh. You know what I'm saying? Like I said, it's my main man right here. You know what I'm saying? I just did 5 years in prison. I just got out, man. And through me being in prison, I used to be on the phone talking to the dog, and he started trading, and I watched him go from just started trading to a profitable trader, man. So this man know what he's talking about, man. So it's just a blessing to have him help me, and hopefully this can help y'all too.
Hell yeah! So we're gonna get straight into it. So, off rip, I gotta tell you about, there's 4 different markets that you can trade. So we're gonna go over every single one of them, and I'm gonna tell you my thoughts on them, and we're gonna get into it. So look, boom. The first market is called the stock market. That's where you get all the big companies like Tesla, Apple, Nvidia, AMD, Microsoft, Google, all the big companies you could think that's, running the world right now. They are in the stock market. Any really big company that's anywhere from from cars to manufacturers to Home Depot to Verizon to anything, it's in the stock market. There's a stock for it. So you can trade those in the market. So that's pretty much the stock market. Is the overall index. There's things called SPY, which is an ETF. It's pretty much a bundle of all the top 500 stocks. That's SPY, and that's U.S. stocks. It's all the top performing, the strongest stocks that's in the market. So pretty much we go on SPY and look how the overall U.S. market's doing. That's one good thing to look at. And then there's a bunch of other things that we're gonna get into later. But boom, that's pretty much the stock market that trades in the market. Right under that is futures. So futures is similar to the stock market, but it's mainly like the indexes. Like ES is reflecting SPY, and then there's NQ, which reflects QQQ, and that's pretty much like a tech sector. It's tech heavy sector, so all the technology stocks are gonna be on NQ or QQQ. Yeah. So if you want to look on, how is the tech side of the market doing? You're gonna check the QQQ versus SPY is the broad-based overall market. Yeah. So futures, they trade different from the stock market, and I'm gonna get into that later into the video. But boom, we got stock market, futures, and then there's forex. Forex is foreign currencies. So you can trade the Japanese yen, you can trade Canadian versus USD, you can trade whatever. Any currency in the world, there's a pair and you can trade them. And also you can trade gold on Forex. NAS 100 is pretty much like SPY and ES. Other than that, that's Forex. So you can trade currencies all around the world because they move just like that. And then we got cryptocurrency, which like Bitcoin, Ethereum, Solana, a bunch of other stuff. So those are digital currencies that we can trade that move up and down. So what I personally do is the stock market. I started with the stock market. I tried everything else, and I just prefer the stock market. And I feel like it's a little bit, I have more of an edge on the stock market because the stocks, you can check their earnings. Are they profitable? Are they growing in revenue? Are they, there's more things you can look at in the stock market versus, crypto or Forex. There's not really too much you can go off of besides the whole overall economy. But you got to think about it. The stock market runs the world because everything that we do is going through the stock market. So think about all the oil we use, gas stations, all the utilities we use, from electric to the phone companies to the clothes we wear. They have that in the stock market, and we can see how those companies are doing. And think about like Apple. Everyone buys iPhones. and iPhones are always gonna be created, and no one's ever gonna stop buying iPhones. That's just gonna keep going. So in reality, the stock Apple will always go up longer term, because there's always going to be new inventions, new AirPods, new iPhone, and our generation is just going to keep buying it. You feel me? So in theory, the stock market will always go up long term because us, the consumers, are going to always be buying. We're buying, which grows the revenue and cash flow for the companies that's out there, and it's just going to push the whole market up. So I'm going to show you on a chart later. The market will always go up forever in time. The only time the stock market will crash to zero is if everyone stops buying stuff, if everyone dies. So stock market will always be moving, and there's always will be volatility and movement in the market over time. So yeah, so overall, I love the stock market because of that reason, because you have an edge on all of those companies and stuff like that. So we're gonna get into this real quick. 3, 2, 1. So boom, we went over the 4 markets that there is to trade. Now we're gonna go over something that's important, and it's gonna be stocks versus options. So really it's shares versus options. Let me change that, because in the market you have shares of a company,
and then you have options,
and then you got options, which you can trade the contracts. So shares versus options. So shares of a company, when you buy a share, you technically own a part of that company. You have partial ownership. And when you have that share, there's no time limit for you to sell it. There's no, there's nothing that's gonna, get you out of it besides you. You buy it and you sell whenever you want. And shares, typically, they move depending on what stock you're looking at, or if you're looking at the overall S&P 500. Shares move certain percentage a day, but most of the time they'll move like 0.5% or 1%, 2%. You're not going to get much movement in shares. So like when I day trade, I don't day trade shares, because you would have to have like $1 million to make 1%, to make 10,000 yet. So if you have, a lot less money, you can do option trading, which is technically 100 times leverage. So you can, you could put $1,000 and you can make $1,000, versus if you put $1,000 on shares, it's really hard for a company to double your money like that. So think about it like this.
Shares more like a long
term, right? So think about the company Apple, right? Let's say we're at $200 per share, right? And you wanted to put $1,000 and you want to flip the $1,000. For your $1,000 to flip in shares, Apple would have to double their sales, double their revenue, and their total evaluation, which is, I don't know. Let's see how much Apple is worth in the stock market. How much is Apple?
So Apple would have to double their sales for you even to see like double your profit.
Not even in sales, they have to as the capitalization. So right now the Apple's market capital is $4 trillion. So Apple would have to hit $8 trillion for you to double your 1,000. So think about that. That's a lot of money, bro.
Yeah, boy, you gonna wait a minute on that one.
Yeah, exactly. That's a lot of money, man.
So wait a minute on that one.
So that's gonna take years. That's gonna take years for it to happen. You feel me? But it's not impossible. But it just takes time. So if you're trying to make a living off of it, you see how long it's gonna take.
Yeah, it's not necessarily something that you can.
Shares is more like you park your money into it and you just let it ride over time, and you add to it. Because like I said, ideally the market is always gonna go up. So you just put it. Yeah, there's gonna be pandemics, there's gonna be recessions, but that's honestly the best time to buy, when the market crashes. Everyone thinks
bounce back after that.
Exactly.
It's always gonna bounce back after that.
Exactly. So you want to stack your bread up and wait for the market to crash, and then you start throwing. That's when you throw in boatloads and stuff, and you put in money you don't care about, that you don't need right away. Think about 5, 10, 20 years from now. That's what you're putting up into shares. That's to be like safe. You feel me? Now options, this is where we get into it for real. So with options, you got to think about, there's different expiration dates. So there's short-term options and then there's longer-term options. So there's 3 different categories that we're gonna go over with trading right now. So there's gonna be day trading, swing trading, and then leap trading. So with all of these, they have different time limits, to different time zones that we trade. Exactly, different expirations. So day trading is buy and sell same day. So you get into a day trade and you sell it the same day. Same exact day. Swing trade is holding overnight. Holding overnight 2 months. So swing trading is when we get in a position and we hold it overnight. That's technically a swing trade. And then leap trade is holding over 1 year. 1 year. And technically it doesn't have to be a whole year, but the expiration date is over 1 year. So whenever you get expiration date over 1 year, that's pretty much like a leap trade. And you want to hold it for long term. So going over all of these, day trading, you're in and out the same day. No matter what, it's the same exact day. You buy and sell, whether you make profit, you lose, or break even, whatever. Swing trade is if you get in a trade and you hold it overnight, that's considered as a swing trade, and you can hold those for weeks up to months. Once you go over the year mark, that's leap trading. That's longer term options contracts.
So I could have a swing trade for like 10 months.
10 months. That's swing trade.
But if anything over 12 months now,
it's considered a leap trade. Yep. So pretty much day trading is what I specialize in, and what I do is because I know I could see my money fluctuate, and I could get in and out the same day, and I can control how much I make and how much I lose. Well, you really don't control how much you make, but the only thing you can control is how much you lose.
Right, absolutely.
So day trading, when I'm in and out and I'm looking at, my trades play out, I know how much I'm risking. And while the market is open, you can sell it and I can get out. So if worst case scenario, I'm willing to risk 500, I know at the end of the day, I will lose 500 and call it a day. You feel me? So when you get into the field of swing trading and stuff like that, you got to know the market moves when the market's closed too. So absolutely. People think that the market only moves when it opens. So the market opens at 9:30 Eastern time and they close at 4 p.m. Eastern time. That's when the most movement happens, you feel me? Especially at 9:30 to 11 a.m. is when I trade. Usually the first hour and a half you'll get the best and most volume and volatility. But yeah, so that's usually when I day trade. But when you go into swing trading and you're holding positions overnight, it's a little bit more riskier because there can be something crazy that happens in the market. Let's say something, a country goes to war and something gets bombed, or something happens, that shocks the whole world with news or something, and the market shoots down. So you can literally be swing trading calls, betting for a stock to go up, and then let's just say something happened to a company. Let's say you're swing trading Tesla to the upside, right? And then Elon Musk comes out and there's news saying, oh, his new Tesla models just blew up, like the cars are blowing up and they're not going good. The whole market, the Tesla stock is gonna drop down. It's gonna gap down heavy. And when you're in that swing trade, you can't do nothing when the market's closed. Because when you're trading options, you can only buy and sell when the market's open. So if the market is closed and then something crazy happens and Tesla is selling off crazy, you can't do nothing. You can't do nothing until the next day, until the market opens. So you can be in a swing trade and the next day you can be down 60-70%. You can be down a lot, on your position, and there's not much you can do. So when I do swing trades or anything longer than that, I usually go with less money than I day trade because of a significant risk, that could play out. And leap trades are really good when you find a company that's dipped down a lot and it's a good valued company and you project it to go up and grow over the next year or two. So if you see a company and it's down 50% from its highs and it's a really good company and you believe in it and you think it's gonna go up, you can get the leap trades. So like I said, you know how Apple had to double its valuation for you to double your money?
Right.
So with leap trades, Apple doesn't have to double. You can literally put your money in for over a year, and if Apple does, like a 20-30% move in the shares, it can literally be 100% move on the leap trade. So you can double your money if Apple moves a quarter of,
just a little bit.
Yeah, like
Not
it doesn't.
as much,
yeah, not as much as having shares.
Versus doubling.
Exactly.
Okay,
If
fine.
shares doubling. So let's just say you have a leap trade, and let's say Apple, it doubles within a couple months, a year. Let's just say it goes crazy. Instead of you just doubling your money in shares, with options, with the leaps, you can do 500 to 1,000%. So you could 5 to 10x your money versus only doubling it with shares,
Right,
But the shares, they never expire. You can hold them for as long as you want. The day trades, swing trades, leap trades, they have expiration dates.
Yeah.
So the closer it gets to expiration dates, the less value it has if it's not going in your direction.
Right.
So if you have a leap trade, it can not do nothing, but once it starts shooting up and you're making your money, and the closer it gets to expiration, it can start to lose value if it doesn't keep going your way. You know what I mean?
Right.
So that's something you got to be careful with options. And when you're trading options, it's kind of the hardest thing to learn versus all the other markets, because you have something called the Greeks. And the Greeks is pretty much like, I think 5 or 6 variables that make the option contract move, which is the initial price of the stock moving, how fast it moves, the time limit, the expiration date it has, and then a bunch of other things, which, we're going to read over later. But even to this day, after me trading for almost 5 years, I can't really sit here and explain everything, because it's kind of complicated. And honestly, you don't need to know every single thing about it.
Yeah.
You just need to know how it moves,
Right.
and once you're in tune with it, then you really know how it works. You
Right.
feel me? You don't have to sit there. You don't got to be a nerd, and you don't have to sit there and know the definition to every single thing.
Right.
And all of that, because I can't even sit here and explain half the shit I know. I just know how it moves from experience. So you have to know about the Greeks and stuff like that. And once you have an understanding about that, then you'll really know like how these option contracts moves. So when we go into day trading, I usually get the shortest expiration, which is usually a weekly expiration. So if it's, let's say it's Thursday today, if I'm day trading something, I'm gonna get Friday expiration, which is tomorrow. So that's pretty much the nearest expiration you can get on like Nvidia, Apple, Amazon, anything you trade besides the S&P 500, the ETF, S&P 500, QQQ, IWM, all the big ETFs that have a bunch of stocks in it. They have expirations every single day, so you can trade the same day expirations on all of those. But usually when I day trade, I want to get the weekly expiration, like 1 day to 3 days out. You can trade the same day, 0-day expiration is what they call it, 0 DT, but those are so volatile and they're so hard to like manage your risk.
Right.
So when I'm trading, I do something called the 20/20 rule. So the 20/20 rule is I take 20% of my account. So 20/20 rule. So I'll take 20% of my account. Let's just say, for example, I have $10,000, 10K. I'm going to use 2K per trade. So I have a $10,000 account. I'm going to put 2K per trade. And then the other 20% is what I'm risking on 2,000. So $2,000 divided by 20% is $400 is what I'm risking.
Right.
So this is pretty much a rule that you can use and when you're starting out trading to help you manage your risk. This is like a risk management plan.
Okay.
So if you have $10,000 in your account, use $2,000 per trade, you risk $400 max. So that will kind of give you a guideline. Okay, I can lose a good amount of trades and still not lose all my money in my account. Same thing with a $5,000 account. Do the 20/20 rule. You're going to use $1,000 per trade and you're risking 20% of 1,000, which is $200.
Right.
You feel me? So that's kind of what you're risking. and that's a good risk management plan because you would have to lose a lot of trades for you to blow your account. You know what I mean?
Right.
And when we're taking trades, we're looking for something that is 2-to-1 risk to reward ratio. So 2-to-1 risk to reward is called 2-to-1 RR. So pretty much we're risking on a $10,000 account, $2,000 per trade. We're risking $400. That's our risk. But we want to try to make double what we're risking. So when I'm risking $400, I'm trying to make at least $800 or more.
Right.
You feel me?
Right.
So I could lose 2 trades, but then 1 trade can make it all back up. You know what I mean?
Right. Facts.
So even if your win rate, if you take 10 trades and you win 5 trades and you lose 5 trades, guess what? You're still profitable because you have a 2-to-1 risk to reward ratio. You're making more money than you lose. So you can literally lose. Let's say you put $1,000 on 5 trades and you lose all of them. 2, 4, 6, 8, 1,000. You're down $1,000. But then your next 5 trades, you win double what you lost. So you make 400, 8, 12, 16, 2K. Minus it out, you're still up $1,000.
Yep.
Even though you were wrong half the time. You know what I mean?
Yep.
So that's why we look for
that's fine. Yeah.
2-to-1.
Yeah, that's fine.
Yeah, exactly. So there's traders that do 1-to-1 risk to reward and this and that, but you have to have a higher win rate for you to be profitable. You feel me? And then you can do 1-to-3, 1-to-4. You could do all of that, but ideally 1-to-2 is the best risk to reward. That's how I run it. That's kind of how I run it with my trading system. And there's days where I'll make 5 times my risk. I'm risking 400. I can make 2,000. You know what I mean? There's days you hit really good, but I know I can only control what I'm risking. You can't control how much you're gonna make.
You can control what you risk.
Exactly.
Facts.
So as a trader, your job is to manage your risk because that's the only thing you can control is your risk. So if you know how much you're losing and how much you're willing to risk, you have that good foundation that you can't let it break. If you have good psychology and the foundation of your risk management using the 20/20 rule and 2-to-1 risk to reward ratio, you're gonna be profitable if you take the right trades from the right strategy. Which I'm gonna get into the strategy in a different episode, but this is pretty much like the foundation of how I would run my account. Absolutely. You feel me? So other than that, we're gonna go on to the next thing, and we're gonna go over bull versus bear markets, bullish structure versus bearish structure. So right here, this is a chart, a line chart, and it's moving up. This is what we're gonna call a bullish structure. You know why we're calling this a bullish structure?
Because it's rising.
Because it's rising up. And we're making right here. Oh my God! Hold on one second. Boom. So right here, we're making. All right, stop tweaking with me. Boom. So right here, we made a high, and then right here we made a higher high. So you saw there was a high point here,
right? And
then this point was the next higher high, and then we had a low point right here. Look, we had a low right here, and then this low we have a higher low. So that's kind of how we call it.
This is a low, so this is gonna be okay. That means
exactly. So right here's a low, right here's a high. Look at this low. This low is higher than that low, so that's called a higher low.
Right.
And now this high is higher than this higher point.
So that would be the next HH.
Yup, higher high. That would be the next higher high right here. So when you see higher highs and higher lows, you know you're in a bullish structure because it's moving up. Right. Our highs are making higher, and our lows are becoming higher too. You feel me? So that's called a bullish structure right here. Boom, boom. So this is gonna be bullish. It's what traders call bullish. When the market's going up, they think it's gonna keep going up, and that's bullish structure. Boom. Now we're gonna go over the opposite right here. Now we come down, make a high, come down. What is this?
So this is gonna be a lower low.
Lower low, perfect,
100%.
Perfect. And then right after that.
So this is gonna be a lower low. This is gonna be a lower high, lower low again.
Exactly.
Lower high right here, and this is gonna be So it's the high.
Exactly. So lower high. So when you see the highs are becoming lower and the lower
So
the
it's
lows
consistently.
is dropping consistently. So this is what we call bearish structure. Boom, boom. This is gonna be bearish. Bearish structure right here. So bearish structure, lower lows, lower highs. So those are the difference between bullish and bearish. Now, what we call a bear market, we get into bear market territory when we're down 20% from highs. So right now we're on the daily chart on the S&P 500, and now we're gonna go over the chart right here. So right here's the chart, and we're gonna go to the previous bear market we had, which was in 2025. It was the tariff war. So from this high, we're gonna click it, and we're gonna drag it to the lowest low right here. That's negative 21%. So technically, we were in a bear market in April of 2025 of last year. We were in a bear market because Trump came out with the tariff war with China.
Yep.
Boom, market got clapped. But guess what? We were claimed back up, and we started making newer highs, and we pushed up higher. So from this previous high, look, we started pushing up a lot higher, and then we had a little dip again, and now we're back even higher on the chart. So right now, right here, recently, from the low of March until June, we're in a bullish market. Because look, we just been shooting up, we've been pushing up so high from the lows. You feel me? We take the low, we mark it all the way to the high, up 20%. So we're in a bullish market right now. And this is, you can see we have that bullish structure, and you can see the overall market, when we zoom out, rise.
So I want to say, is it always usually like that? Like the stock market is always rising?
The market will always rise
Right.
if you think about decades and years and years.
So
Look,
it's gonna yeah,
we'll go literally all the 2012.
Yeah, bro,
You see, there's dips. We had the tariff war in 2018 with Trump. We had COVID. That was 20%. The market dropped from COVID. And then right here, 2022, we had a little drop.
Took flight after.
Yeah, look, bro. Every time we dip,
It comes back stronger. Bro.
It comes back stronger and
than
it
it ever
pushes
was
on.
before.
Exactly.
Yeah, so it's a
and
new
it keeps
higher
going
here.
and keeps going. So this is what you really have to understand is, yeah, we're gonna be trading, day trading, making our money, but we want to start accumulating money and putting into long-term shares.
Facts.
Because the market will always go up.
Yep.
So when
money always going to be making money.
Exactly. We're in our 20s right now. So think about, we do this for 30, 40 years. When we're in 50s, 60s, our money will literally 10x long term. Our money is just going to keep going. Literally, like, let's say we're in 2026 right now. Let's go on the weekly chart. Let's look at where we were at in 2016. Let's look where we're at in 2016. In 2016, we were right here. In 2016, we're going to click the low, and we're going to go to where we're at today. We're up 375%.
Damn. Bro.
So think about it.
Yo,
if you put $10,000, you would be up 37K in
Right.
10 years. And that's just putting it in once.
Yeah.
And that's it rising over time, over 10 years. Now, think about if you're adding money consistently, bomb, every month for 10 years. You would be up so much money here.
Yeah.
So let's look at the investment calculator right here. All right, let's just say you have $10,000 to put into the market.
Facts.
Boom. Annual return 6.5%, and we contribute $1,000 every month. And everybody could grind hard and contribute an extra $1,000 into investing into themselves, right? So boom, we're gonna do a calculation. Boom, after 10 years, your account's gonna be at $188,000 right here. After 10 years, from $10,000, just adding $1,000 every single month. So we're young, we're in our 20s, right? So let's just say we did that for 20 years in a row. Boom, look how much that compound shot up. $500,000. The first 10 years, we made $188K. The
Facts.
second 10 years, $500,000.
So as you can see, the second 10 years it went up more than it did the first
Way
10.
more because
Yeah,
you
facts.
had compound interest on your side.
Right.
It compounded more. You feel me? So that's the thing. That's the beauty about compounding, because when you have more time, you can shoot up. So you can make so much more money. So now let's just say we did it for 30 years. We in our 20s. Let's say we did this into our 50s. Boom, $1.1 million. You see, the first 10 years we was up 188 grand. 20 years, $500,000. Now 30 years, guess what? $1.1 million. And that's a good amount of money. That's like generational wealth. You feel me? And all from compounding, all from not doing anything, just putting in money into the market and just letting it ride. Not worried about what's going on. No, nothing. You just do it every month. You just throw in a little bit. Just from $10,000. Now let's just say we do it into our 60s here. This is the real game changer. Boom, straight into our 60s, 40 years, $2.4 million. Literally in 40 years from 10K. And just $1,000 every month. You could have $2.4 million in 40 years. Literally, you can retire off of that. And guess what? With that amount of money, you can literally get a loan against your stocks without selling it. And you can go ahead and buy real estate. That will cash flow. Investment property. You can get a hotel, whatever.
That's
a triplex. Wealth. Yeah, generational wealth. Right. Now you get money from the real estate to pay off, your loan or whatever. And then guess what? Now your property appreciates in value over time. So this is why they say the rich get richer, because they don't have to sell their stocks or use their own money.
They do collateral against
just use collateral, use a loan to get real estate, all of that. When that value goes up, they can get a loan on the equity they built, and then they just keep stacking it up. So that's how you build generational wealth from compound interest from the market and real estate. So like that's the beauty of it, man. But hey, look, it's gonna wrap up our episode 1, trading from scratch. Literally, I'm gonna take him with no knowledge to becoming a profitable trader within 6 to 12 months, man. Stay tuned, and we're gonna get right to it, man. Peace out, y'all.
Peace out.